You are burning your retirement savings by chasing high yield dividend traps. Most retail investors believe passive income is a lottery, but it is actually a precise engineering problem. By analyzing a 5% yield against a 3% inflation rate, you can mathematically determine the exact portfolio size required to cover your living expenses indefinitely. I will show you the exact variables to calculate your freedom number and avoid the common traps that bleed your principal dry. To stay retired, let us sit back, grab a cup of water, and get to work on your financial independence. To start, we have to define your number. You cannot build an engine if you do not know how much power it needs to produce. Pull up a spreadsheet or grab a piece of paper and write down your total annual expenses. Let us say, for this example, that you need $50,000 per year to maintain your lifestyle. That is the output you need your portfolio to generate without you ever lifting a finger. Think of this as your personal salary paid by your assets. Now, here is where the simple math kicks in. The first method, and the one that provides the most stable foundation, is the dividend growth model. You are not looking for the highest payout today. You are looking for businesses that grow their payout every single year. Consider a company like Johnson & Johnson or Procter and Gamble. These companies are what we call dividend aristocrats, firms that have increased their dividend payments for at least 25 consecutive years. If you hold a basket of these companies, you are not just getting a yield, you are getting a raise that outpaces inflation. A 2% starting yield might seem low to the uninitiated, but if that company increases the dividend by 7% annually, your yield on cost will explode over the next decade. Does that make sense? You are buying a machine that gets better at producing cash the longer you hold it. A 2024 study from the Center for Retirement Research found that retirees who relied on dividend growth stocks were 30% less likely to panic sell during market corrections than those who relied on selling principal. The psychology of receiving a check, regardless of what the stock price does, is the ultimate anchor during a crash. Now, here is where things get a bit more technical. You have your target of $50,000 and you know you want growing dividends. You need to calculate your required portfolio size. If you aim for a portfolio yield of 3%, you divide 50,000 by 0.03. That equals $1.66 million. That sounds like a massive number, and for many, it is. But remember, you are not saving this in a vault. You are compounding it through reinvestment before you ever hit your retirement date. If you start with $50,000 and add $1,000 a month at a 7% return, you get there much faster than you think. If this is clicking for you, hit subscribe. I break down these math-heavy strategies every single week, and I want to help you build your roadmap. Let us move to the second layer of this, which is the level up moment. This is where you optimize for tax efficiency and reliability. Most people ignore the structure of their accounts. If you hold high dividend stocks in a standard brokerage account, the tax man is taking a significant cut every year. That is a leak in your engine. You need to be utilizing tax advantaged vehicles like an IRA or a Roth IRA, where those dividends compound tax free. I remember a friend of mine, David, who started his journey 10 years ago. He was obsessed with high yields and chased companies paying out 8 or 9%. He was getting massive checks, but the company valuations were cratering. He learned the hard way that a high yield is often a sign of market distress. Instead of relying on single high yield stocks, he shifted his focus to dividend focused index funds like VIM or CHD. By diversifying across hundreds of companies, he removed the risk of any single firm cutting its dividend and ruining his cash flow. His portfolio went from being volatile and risky to a predictable stream of income that he could count on month after month. Okay, remember how I said the best one was coming? Here is the one I have been saving for you. The third and most powerful method is the concept of the dividend safety buffer. Even if you have the math perfect, life throws curveballs. You might have a medical emergency or an unexpected home repair. If your income is strictly tied to your dividends, a sudden market-wide dividend cut, like the one we saw in 2020 during the global pandemic, could leave you stranded. The solution is the cash yield ladder. Instead of just collecting dividends and spending them, you build a cash buffer equal to 2 years of living expenses in a high-yield savings account or short-term treasury bills. Think about the math here. If you have 2 years of expenses in cash, you are effectively immune to market volatility for 24 months. If dividends get cut across the board, you do not have to sell a single share at a loss. You live off your cash buffer while the market recovers and companies reset their payouts. This is the difference between an amateur investor and a professional retiree. It is almost boring how well it works. Once you have that buffer in place, you realize that your portfolio is no longer a source of anxiety. It is a source of absolute freedom. Let that sink in for a second. That one shift alone provides more security than the first two strategies combined. Once you see your income stream through the lens of a buffer, you can stop watching the daily charts and start watching your life expand. So, we cover the dividend growth model, the importance of tax advantaged indexing, and the ironclad security of the cash yield buffer. These aren't just theories. They are the mechanics that have allowed thousands of people to walk away from their 9 to 5 jobs decades before they were expected to. It is not about timing the market or finding the next hidden gem. It is about the math of consistency. If you found this helpful, share it with someone who is tired of the grind and make sure you subscribe so you don't miss the next breakdown on wealth optimization. I am putting together a video for next week on the specific tax implications of different dividend types, which is going to be a game changer for your net take home pay. Stick around for that. Thanks for spending this time with me today. You are building something real, and that matters. Go out and put these numbers to work. See you in the next one.